Welcome back. On to some commodity action then. Citi is now saying that gold prices can go up to $3,500 an ounce if concerns on US growth remain higher due to these reciprocal tariffs if they are implemented by President Donald Trump. Manisha Gupta caught up with Citi's global head for commodities, Max Layton, and spoke to him on precious metals and their outlook going forward as reciprocal tariffs loom. Listen in to that exclusive conversation.
We think gold price is going to keep going up. Bottom line is we're in the underlying drivers, the physical and we would say fundamental drivers of this gold bull market remain in place and will continue to drive gold all the way up in our base case to $3,200 an ounce over the next couple of months, and then potentially up as high as $3,500 an ounce if we're in more of a concerning US growth environment than what we have in our base case.
Max, also, where do you see all of this buying coming in from? I mean, we do understand that the central banks are buying and ETF buying has also been quite strong. The kind of gold that we've seen being shipped from UK to US is yet another story. But to take the prices from where they are to 3,200 and 3,500, where is this new buying going to come from?
Yeah, I think you've named all the core recent drivers. We think a lot of them remain in play. In particular, President Trump and his team, they've mentioned some pretty high headline tariff figures on April 2, on Liberation Day, as President Trump's calling it. And these kinds of tariffs, if delivered, even if half of them are delivered, are going to be concerning from a global growth perspective, but also from a US growth perspective over the next 3 to 6 months. So that would kind of cement, in our view, a continuation of what we've seen over the last couple of years, which is a very gradual slowing in US economic growth. Around that, in the past, we've tended to see savings rates rise, ETF demand rise alongside that, with the driver of both being precautionary savings from households. And we think this is kind of going to take you that next leg higher over the next quarter or two.
Max, also, what is your sense on the silver prices? Because the prices have had strong fundamentals, the industrial demand deficit, but we haven't seen $34 an ounce break on the higher side. How are you looking at fundamentals and the price move from here?
Yeah, I think stepping back, this silver price is fantastically high versus mining costs relative to, even if you take a 50-year silver chart, this is a pretty high price by historical standards. So silver's done well. It's doing well. It's up. It was trading in the low 20s a bit over a year ago. So the price is doing extremely well. It perhaps has disappointed some of the kind of stronger bulls. It hasn't exactly significantly outperformed gold, so it hasn't been the leveraged kind of play to gold that a lot of people were looking for. And really, that all comes down to the soft global growth environment. So we think silver, it's got a lot of exposure to a bigger than expected China easing, for example, or and it continues to kind of probably give you roughly the same, maybe less return than gold over the next couple of months. I think the thing that's stopping us getting super excited about silver, and we are modestly bullish from these price levels over the next 3 to 6 months, getting up to $34, $35. The thing that's stopping us is this tariff threat from President Trump. So less tariffs than expected, together with some China easing, and silver can come in more in line with our bull case scenario towards the $40 mark.
We've spoken so much about tariffs, Max. Going forward now, what is the worst case scenario or the best case scenario when it comes to tariffs going forward?
I would say one of the worst case scenarios is that the reciprocal tariffs that US Commerce Secretary Lutnick said that their finding was what would raise $700 billion, that those are enacted fairly immediately, and that those are not redistributed. On top of that, that you have a higher headline number than the $700 billion because because the administration might want to negotiate down from an even higher number. So kind of worst case scenario for me on April 2 is a 15 to 30% tariffs across the vast bulk of the imports implemented immediately and not redistributed to people either through no tax on tips or to kind of middle income and lower income people on incomes less than 150,000 US dollars. I mean, if that happens, that's the worst case scenario, I think. The best case is for me is, something like 5 to 10% tariffs, which would still be a pretty big headwind for global growth, in my opinion. And for metals and commodity markets more broadly, and that they are kind of either phased in or industries with complex supply chains are given time to phase in, and that the revenues raised are near immediately redistributed. That would kind of minimize the impact of the shock. On top of that, China and Europe stimulate to kind of offset the impact on their economies. And in that scenario, I think, you can be looking at what U.S. Commerce Secretary Lutnick mentioned about, President Trump and their team owning the economy from the fourth quarter of this year, which would be essentially that the fourth quarter growth outlook is better and even better into 2026. So that's probably the best case. And even then, we've got some pretty serious adjustment to global trade coming over the next 3 months.
An exclusive conversation there with Max Layton of Citi on gold and all things commodities. But with that, we call time on this edition of Halftime Report. From Nigel, me and the team that put this show together, thank you so much for watching. We leave you with the Nifty still at 23,600. Business Lunch takes the action forward.